Let's talk about a zero coupon bond. Most bonds will pay you income. Generally, it's semi-annually, which is twice a year. So a bond, just as a reminder, is an IOU. It pays you interest income mostly twice a year. Could be monthly as well if it's a collateralized mortgage obligation like a Fannie Mae, Freddie Mac, or a Ginnie Mae. And every bond is going to be, it can be either secured or unsecured, which means it has collateral attached to it. And it's going to be based on the full faith and credit of the company. So it's as good as the company's name and word is. So now, with zero coupon bonds, it's a slightly different option. You're actually not receiving any income till the bond matures or ceases to exist, basically. So what does that actually mean in practice? So just to give an example, let's say you were to borrow $10,000 from a friend and you say, hey, I will pay you 10% interest for 5 years and I'll return the $10,000 at the end of the term. So what does that look like in terms of payment schedule? You'll be paying them, let's say twice a year, you're paying 500 bucks, 500 bucks, right? 500 bucks, 500 bucks, 500, 500, 500, 500, 500, 500, and then 500 and then 10,500. So the remainder, the last interest payment, and then the remainder of the principal, right? Now, if it was a zero coupon bond, it would be like, hey, Bill, can I borrow $6,000? And at the end of 5 years, I'll just give you 10,000. But you're actually not going to get anything paid in the meanwhile. So you'll get, 0, 0, 0, 0, 0, 0, and then 10,000 at the end. So what does that look like from a tax perspective? So from a tax perspective, you actually pay tax on what's called the phantom income, which is basically income that you're not actually receiving but expected to receive. So, for example, in that scenario, right? So from $6,000 to $10,000, that's $4,000, right? And that's going to be over 5 years. So you're basically averaging $800 of income every year, and that's what you're actually going to pay taxes on, even though you haven't received the money. So that could be a problem, a cash flow problem for some folks. Now, there are some federal zero coupon bonds, and they're called strips. So if you take a T note or a T bond, remember they have a maturity of like 2 through 10 if it's a T note, and then more than 10 up to 30 is a T bond. And then let's say you take one of those and you strip out the coupon, right? That's what the government does, and you basically buy it without the coupon. So kind of allows it to compound a little faster and grow. But with zero coupon bonds, they are extremely sensitive to interest rate risk, which is called duration. They actually have no reinvestment risk. Reinvestment risk is the risk that, let's say, you're collecting bond interest and all of a sudden interest rates go down and you have to reinvest the interest you're getting from an 8% into like a 6%. But with zero coupons, you're not getting any coupons, so there's actually no reinvestment risk. But it's very high interest rate risk. So if interest rates go up, your bond's going to collapse in value. If interest rates go down, your bonds could increase in value quite a bit. So yeah, going back to strips, that's the federal version of that. So it's going to be guaranteed by the government. Because of the taxation, sometimes it might make more sense to hold it in a retirement account or maybe a Coverdell or some kind of college savings account, perhaps a 529 if that option is available. Then there's also something called Treasury Receipts, which is basically a broker dealer basically synthetically creates the zero coupon bond from like a T note or a T bond. So it's not going to be as safe as the government one, even though the underlying security is risk free. The problem is that the broker dealer is doing it for you versus like the federal government. So it brings on a little bit more risk. So hope that kind of makes sense in terms of zero coupons. Thanks.